Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent having a controlling interest over 51% but not full 100% interest in the subsidiary. Therefore, we will be dealing with a non-controlling interest. Our major focus will be where the parent is purchasing S bonds from a third party at a discount. In other words, S issued bonds at a prior time, but not to the parent. They issued bonds to outstanding third-party bonds. Then the parent came along and purchased the bonds from the third party related to S. When they purchased the bonds from the third party, they purchased them at a discount. Now we have a situation where P has bonds that they purchased of the subsidiary S, but they didn't purchase them directly from S. They purchased them from a third party. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We're going to have our information on the left-hand side. We're going to enter that information into the blue area on the right-hand side where we're going to have our worksheets we will be entering into. We will then have our journal entries, our elimination entries, and our consolidation worksheet having P and S company trial balances. We will sum up, total up, and then do our elimination or consolidation entries for. Going all the way back to the left, let's see what our data will be. P purchased a percentage of S voting common stock on January 1st, 2000 x 0. So that's going to be the point of consolidation, the time period which the purchase took place. 75% is the controlling interest, 25% then non-controlling interest. 2000 x 4, P resold inventory transferred from S in 2000 x 3. So we're going to say the date of consolidation will be 2000 x 4, December 2000 x 4. We will then have intercompany transfers of inventory we will have to be dealing with. That means that 2000 x 4 is the current year. Prior year then is going to be 2000 x 3. So the cost for S was 53,000 and P cost is going to be the 68,000. Then we have in 2000 x 4, P purchased inventory for 49,000 and sold it to S for 69,000. And then in 2000 x 4, the current year that we're going to be consolidation in, they still hold 31,050 of it. And then we have our kind of concentration here, or the newer thing that we're going to be throwing into the mix. S issued bond at on January 1st, 2000 x 1, so not in the current year, in a prior year. The face amount 190,000. Interest 8%, 10 years, issued at 104. So notice they issued the bonds. They didn't issue them to P, however. This isn't a bond that went directly to P. They simply issued the bonds. And then P came along at a later point in time and said P purchased bonds from one of the original owners on December 31st, 2000 x 2. So now P came along and said, okay, I'm going to purchase some of these bonds, which were S's bonds, that were issued to somebody else, but now P purchased them. The parent now purchases them. So now we've got kind of our issue, our problem here. So the bond face amount when they purchased it was 76,000. In other words, S issued 190,000 of the bonds originally, and that was totally fine. No intercompany or related transaction happening here. But then P purchased 76 of those 190,000. When they were originally issued, they were issued at a premium, 104% of the 190,000. But now P purchased them, and when P purchased them, they basically bought them at a discount, right? So now we're going to have to deal with that kind of issue. That's going to be the newer thing we have. Then we have the straight line method to write off the premiums and discounts. The interest paid annually on December. We're going to be using the fully adjusted equity method. We're going to have the consolidation as of December 31st, 2000 x 4. So we're going to have our worksheet up top. This is going to be our adjustment to the basic consolidation entry. So we're going to do this basic consolidation entry. We're thinking about those types of things that might affect the income statement typically for S. And those are usually the things that we might adjust our original entry for. We might use a little table here. And so we'll come back to that table and work through it in the future. Then we'll have down here the consolidated cost of goods sold for 2000 x 4. Let's first take a look at our transactions, our upstream and downstream kind of transactions. And I've included, the full range of things that we might want to consider, and then we'll just enter the amounts that are applicable. But I want to include like the standard kind of things that can happen, right? So with regards to the inventory, we'll start with the inventory here. We've got the prior year downstream transactions that could happen, the current year downstream transactions that happen. Then we could have prior year upstream and then current year upstream. Those are the four things that we typically would consider, because when we're thinking about inventory, we could still have inventory on the books from a prior year transaction that we'll have to deal with basically reversing. We would expect then it to be sold in the current year, and then we would expect then to have the current year inventory transactions that would be taking place. So that's going to be the typical kind of thing scenario that we would have. So of these items that we have in our scenario, we have a current year downstream transaction, and that's from this data here where it says 2000X4 P purchased inventory for 49,000, sold it to S. So P basically is selling inventory to S there, parent to the subsidiary, downstream transaction happening 2000X4 current year of consolidation. So let's put that information into our worksheet that we'll typically have. And we'll break this out usually into 3 components to break out the full analysis of it. We're going to say, all right, well, the sales price happened at the 49,000. They purchased it then for, the 69,000. They purchased it for the 49,000. The difference is the gross profit. So then it's useful to figure out the gross profit percent, which would be the 20,000 divided by the 69,000. That's going to be the 29%. We might want the cost of goods sold percent, the 49 divided by the 69. I'm going to make that a percent. Notice these are rounded numbers here, so there could be a situation where you have rounding that you'll have to deal with. So that's actually something kind of an ugly number like that. So just keep in mind that you got a rounding issue there. Then we're going to say, all right, then how much is going to be left? They're still holding 31,050. So they're still holding 31,050. So I'm going to start down here then at the ending amount and say, okay, the amount that's still in ending then is the 31,050. If I take these same percentages, noting again, accounting for the rounding that we have involved here, and I make this a percent, it should be a percent on your worksheet, then I can take, all right, there's the 3150 times the 71%. And there's going to be the 3150 times the 29, and that will be the 9,000. Then I can figure out kind of the amount that was resold then would be the difference, or the 69,000 sales price minus the 3150. And then again, I can multiply this times this about 71%, or I could do the similar subtraction problem for the 49,000 minus the 2250. And then I can calculate this, of course, multiple ways. I can double check to see that the gross profit is still the same, 11,000 over the 37,950 at the 29% about. Now we also have a prior year upstream transaction, and so I'm going to kind of simplify this one. That's going to be this up top. So we got, all right, let's highlight this one. I'll make it green, and let's keep it. I'll keep them both green. So 2000X4 P resold inventory transferred from S in 2000X3. So this went from S to P. So it's going to be an upstream transaction in this case. So we got an upstream transaction. The reason it's a prior year is because even though it says in 2000X4, that's what we resold, which means that the original transfer happened in the prior year from S to P, and now we're reselling, which is what you would expect to happen in the current year. So you can think about that in a similar fashion where we could say, all right, well then we would typically take the sales in the prior year minus the amount that was resold, and then think about the reversal happens in the current year. This is typically the amount that we really want down here. But in this case, they basically gave us this bottom line number. They said, all right, they gave us the amount that was resold, inventory transferred from 2000. So we're going to say this is the amount that was resold. So I'm going to kind of jump down to this last component and just say, all right, this is the resale amount, which is going to be the 68,000, and then the cost of goods sold is going to be the 53,000. The difference between the two, 68 minus the 53, is that 15. If we want to look at the gross margin, it's going to be that. Now, again, this is different. This is separate. They could have given us data that basically say, hey, this is what the sales were last year. This is the amount that you resold last year. And then the difference would be the amount that we would expect then that we would sell in the current year, the amount, but they gave us then the amount that's in ending inventory. So I'm just going to fill out the last component, the amount that was in ending inventory last year that we basically would resell this year. that giving us the gross profit of that 15,000. So now let's jump over here and look at the consolidated cost of goods sold for 2000x4. So what we're going to do is say, okay, what's on cost of goods sold? Let's see if we can get to the ending number of cost of goods sold after the consolidation, and just with a table, think about what it would look like. So if I go all the way back over here, we've got P, we've got S. These are the trial balances for 2000x4. If I was to add up and do the total here, this is going to be our first step. I'm going to sum these up. We're going to sum these up. I'm just going to copy and paste this on down. We're concentrating here, so that's going to be our totals on the cost of goods sold. So here's the cost of goods sold for P and S. There's the total cost of goods sold. We're going to have to do an adjustment for it for the intercompany transactions of the cost of goods sold. Let's think about what that ending number might be over here. See if we can do that with a table to think about how to get to that ending number. So we'll go back on over and say, all right, well, if I look at the cost of goods sold, we're going to say this is the cost of goods sold reported by P and S. So I'm just going to pull this from the table. Cost of goods sold reported by P is that 601, and the cost of goods sold reported by S then is going to be the one right next to it, right next to that one, which is the 222. So there's the cost of goods sold. If we then make an adjustment for it, we're going to make an adjustment for the 15,000 here that we have calculated. What did we calculate that? 15,000. We're going to make an adjustment for that 15,000, and that adjustment is going to be for the unrealized profit in ending inventory. So that's going to be a negative of that 15,000. So there we have that. Now that's basically the reversal of the prior period activity that we had, right? The prior period intercompany sale that was in beginning inventory that we're reversing. So we're going to reverse that 15. Then we're going to go down and say the adjustment for inventory purchased from S and resold during 2000x4. So this is going to be the current period, transaction that we had. We had the cost of goods sold recorded by P, cost of goods sold recorded by P. It's going to be the 49,000. I'm looking at this current year transaction, which we're taking from this data. So I'm going to be picking up then the 49,000 recorded by P, and then the cost of goods sold recorded by S. Now we're going to be picking up then the number of this 37,950. You might say, hey, that's in the sales item over here. And so why are you picking up the sales item? Because it's the sales item of the sales up top. But if you think about what's going to be recorded on S's books, they're going to be recording that 37,950. In other words, we said P purchased the inventory for the 47,950, sold it to S for the 69,000, and then S is still holding on to the 31,050. So they're going to say that the cost to S then was the 69,000, and they're still holding the 31. So the difference between those two is going to be the 37,000 that's going to be recorded on S's books for cost of goods sold. So if we then add those two up, we're going to say, all right, let's add those up equals the sum of these two items. We're going to get the 86,950. Now we're going to calculate cost of goods sold based on P's costs. So we're going to start here. We got the amount P sold to S. So the amount P sold to S was this 69,000. P sold to S. S is still holding on to, we're going to say, the 31,050. So the 31,050 is still being held on to. Subtotal, if we subtract those two out, is the 37,000. So I'm going to take the amount P sold to S once again, and we're going to take a percentage then. A percentage of, this is going to be equal the 37,950 divided by the 69,000. That's going to give us our 55%. So in other words, this is the percentage that was sold at basically the sales price. And so now we want to take the cost, the original cost is what we wanted on the books, which was the 49,000. So the 49,000, and then we're going to take our 55% of that 49,000, the original cost. So we're going to say the original cost is going to be the 55% times the 49,000. That's going to give us our 26. Let's put that over here. I'm going to say this is going to be equal to the 49 times the 55%. That's going to be our 26. So that's what we're going to have to adjust this amount down by, because S is recording it on their added or increased cost due to the fact that they purchased it in the intercompany type of transaction. So now we're going to say the 26,950 minus that 26,950 is going to be the 60,000. So finally, we're going to take our adjustments up top and that 60,000 adjustment. So I'm going to say this is going to be equal to the sum. Let's get back on there. Equals the sum of these items, these three items. I'm going to close that up minus the 60 here, the 60 there. That's going to give us our 748. So that 748 is what we will expect to see once we do our consolidation adjusting entries here. That's what we hope to be there. That's what will be there. All right, let's scroll back over and let's do a similar thing now. Let's do a similar thing in a table type of format for the consolidated inventory balance. I'm going to make this one green just to indicate that that's the one we're working on here. Consolidated inventory balance, we're going to a similar process where we would expect then, if I go back on over to our trial balance, we've got our inventory at the 307. Let's see if we can work out to a table what we expect that to be at the end of the day after we make our adjustment. So we're going to do a similar starting process. I'm going to say, all right, let's see if we can do this with a table. Amount reported by P. I'm going to say this is what's reported by P with the inventory. So I'm just going to pull this from our trial balance. This is what is recorded by S for the inventory. So that's what we have from the trial balance. If I'm to sum those up, I'm just going to add them up. There's P and S inventory information. So now we're going to record the unrealized profit in ending inventory held by S. In other words, S is still holding on to some of that inventory, which represents some of the gross profit that shouldn't be in there because of the sale between P to S. It's on the books for an amount that's too high. So we're going to say, all right, then in 2000 X4, S holds what they're holding on to, some type of inventory. I'll pull it from here. S is still holding on to that 31,050 of inventory. So that's going to be 2004. S still holds. Sold it to S4. The amount that it was sold to S4 was the 69,000. It was sold for the 69,000. The total amount that was, and so the difference between those two, or the percentage, is going to be the 3150 that's still being held on to times the 69. So that means 45% then is the amount of the ratio that we're looking for. The gross profit then, the gross profit is this 20,000 or the 69,000 minus the 49,000, the 20,000, and then we're going to be picking up the 45% of that 20,000. So we're going to take the 45% times the 20,000. That's going to give us our 9,000. I want that to be a negative, or let's make it a negative here. Put a negative sign in front of 1. So if we break that down one more time, they're still holding on to 31,050. They were originally sold the 69,000. So that means they're holding on to 45% of what was originally sold. Now, the gross profit was 69,000 minus 49,000 for the intercompany transfer. So the portion of that that's still being held on to then is 45% of that gross profit. And that's going to be the 9,000 gross profit that's being represented in this inventory that's too high. That's the intercompany. So we have to take that out. Therefore, we're going to be summing this up. Going to sum this up. And that's going to be this 37,000 then. If I sum these up, it's going to subtract them. That's going to be the 298. So that 298 then is what we expect then to be in the ending inventory number. So once we do our consolidation, our inventory will be here. All right, so that's going to be that item. Okay, so let's ungreen this. I'm going to ungreen this one. And I'm going to do a similar thing down here. Let's see if we can do a similar table for the computation of the interest expense related to the bonds. Now, this may not necessarily tie out to what's on the trial balance because there might be more included in interest expense than simply the interest expense related to the bonds. But we're going to do a similar calculation. This what would be included with relation to the bond. So we're going to say, all right, in this case, we would say that we'd have the 190,000 you would expect, the 190,000. And we're going to be taking that times the rate, which was the 8%. The 8%. And that's going to give us then, I'm going to put it on this side, the 190 times the 8%, or the 15,200. Then we want to consider the amortization of the premium. So I'll bring this back inside. The premium was 190,000. This was when it was originally issued, right? The 190,000 times the premium, which was 104%. That's what this means, 104. So it was issued at, 104, 104%, 1.04, 104%. So we're going to say then that means that if we multiply this out, we're going to say it was 190 times the 104. It was issued for then the 197.6. So the difference between the 197.6 and the face amount, 197.6 minus the face amount, is the 7,600 amount of the premium at the point in time that it was issued. Now we're going to say that it's 10 years. Periods, we'll say years is going to be 10. And so the amortization of the premium, if we divide that out over the number of years, we're going to say 7,006 divided by 10 is the 760. So we have the 760. Then if we subtract that out, we have the interest payments that are taking place. And then we're taking into account reducing it by the amortized portion of that year's premium, which would be that $14,440. Now that would be the full interest expense before, and it's not taking into consideration the intercompany activity, the amount that was purchased later by P. So we're going to have to take that and account for the fact that P purchased portion of it in order to think about our elimination entry, as we'll do in the future. So then I'm going to make that ungreen this one. We're going to move on down to the computation of interest income. So let's think about interest income. I'll make that green to do so. Now with the interest income, we're thinking about this side of things when P purchased bonds from one of the original owners. So now P purchased the bonds, but they only purchased 76,000. They purchased the bonds from somebody else, not S, but they're S's bonds. So now we've got these bonds, that P holds that are S's, but they're not for the full 190. They're for the 76. These are still 76,000 of the 190 that were issued at this 8%. And, they're the same bonds that have that maturity date that was originally, the 10 years. So we're going to say, all right, well, now they have these at the 76 and they bought them at a discount. Well, that's interesting. So now we're going to go over here and say that we got the face amount is going to be for them is the 76, because they bought 76 of the 190 from a third party. And then that's going to be 8%. It's going to be the same rate that we will have. So we're going to multiply that out. They need interest payments of 76 times the 8%. And then we're going to calculate, they basically have a discount that they would be recording on their books based on this, because they purchased it in essence at a discount. So the face amount was the 76 that they had, and then they purchased it for the 74,480. So they got a discount of the 76 minus the 74,480 of the 1,520. And then we got to think about, well, how are we going to amortize the discount? It was originally 10 years, and that was in 2000 X1. So X1 and X2 have basically passed, so we got 8 years left. So we have the original 10 minus 2 years that have passed. We've got 8 periods that we're going to remaining. So if I take that 1,520 divided by the 8, we're going to get the 190. So then if I was to add these up, summing up the 6,080 and the 190, we're going to get the interest for 2000 X4, the year that we're working on here. Now note that's basically intercompany interest, so we're in essence going to have to remove that or eliminate that. So that's going to be the interest that's been currently recorded. So we'll see this in our elimination entry. So I'm going to ungreen this one. Let's take a look over here then. Let's take a look at the amount assigned to the non-controlling interest. We'll see if we can recalculate that basically with a table type of format. So for this one, we're basically trying to reconstruct. We will be reconstructing, in essence, the ending number here with a table format. So we'll do it with journal entries too, but we're looking for this number here in a table type of format. So we generally take the equity section. So I'm just going to be adding up the equity section just as we would with like a journal entry format. I'm going to take, all right, we're just going to say negative of the common stock for S here. So I'm going to take the common stock for S, so the 40,000. The retained earnings, the beginning portion of retained earnings for S at the 160, Then I'm going to pick up the net income. The net income, I'm picking up all of equity. So I'm picking up the net income, which is calculated down here. So there is that. And then I'm going to pick up the dividends, and I'm going to make it, you know, a negative number here. So that I'm going to make the dividends negative here. And so there we have that. So in essence, if I took all of equity here, we're taking the 268,000. So now we've just recapped the equity here, the 268,000, which would also represent assets minus liabilities, the 268,000. Then we want to get to this constructive gain. Now I'm going to come back to this one. We're going to get back here. I'm going to make that yellow for now. And then we'll get back to that one. We're going to compute that down below. So let's freeze there for now, and then we'll be back up to it in a second. And then let's go to the income assigned to the non-controlling interest. Income assigned to the non-controlling interest. So once again, we're going to use a table type of format to get to the non-controlling interest, this number here. So we'll do it with journal entries too, but let's see if we can do this with a table type format. So I'm going to say, all right, let's see if we can get back on over here and say, we're going to say then the net income, the place we'll start, I'm going to say is a negative of the net income of S, because you would think that it would be the non-controlling income portion of the 89,000, right? The 30%. But we're going to have to make adjustments for it. So the adjustment is going to be the adjustment related to the profit on inventory sold 2P in 2000x2. That's going to be that 15,000. So we're going to have this 15,000 with regards to these inventory items. So this is going to be this one. We'll also see this basically in our table. Once we do this table, that we'll see it here when we do our adjustment to the beginning balance in terms of a journal entry format. So we're just doing it in a table format right now. So then we're going to have the adjustment for realization. Oh, that's the one I already did. Yeah, no, that's right. Adjustment for realization of constructive gain on the bond. So this is another one that we're going to have to come back to. So let's do the calculation below, and then we'll come back to that one. So now let's take a look at this one. This is the computation of constructive gain on the bond retirement. So this is going to be kind of one of the new components here. We'll do this with a table type format. Now this one has to do with this bond that was purchased by the third party. So let's think about, you know, this constructive gain concept. So we got the par value of bonds outstanding. So we're going to say this is going to be equal to the 190 face amount of the bonds. And then we're going to take into consideration the bond premium December 31st, 2000x4, because it was originally issued at a premium, right? And that premium we calculated already. Where did we calculate that premium? Could pick it up from one of our prior calculations. But in essence, I can recalculate it again. It's going to be this 190,000 times the 1.04. And so that's going to be the amount that we received minus the original 190,000. And that's going to be the premium of the 7,600. So we calculated it before, but there's the 7,000. So here it is. Here's the premium calculation. So we could pull it from there as well. If you want to look at that calculation a little bit more in depth, we're going to once again take the 10 years, the number of periods, dividing that out. So we're going to amortize the premium. That means that we're going to have now we're going to say the periods past, the periods that have passed up till the point in time that we are consolidating, which is going to be 2000x4. In other words, the original issue happened in 2000x1. So we got 1, 2, 3, 4. We're going to say 4 periods, 4 years. So I'll just say this is going to be 4. So then the amortization is going to be this times 4, and that's going to be our 3,040. So then we're going to take that 3,040, and then the bond premium then at this point will be the 7,600 minus the 3,040. That's going to be the bond premium as of December 31st, 2000x4. Now the remaining years to maturity are just going to be that 10 minus the 4, so there's still 6 years to maturity. We're just getting back to basically that 760. So I'm going to say the amortization per year is going to be that 4,560 divided by 6, which is just going to be that same 760 because we're using a straight line amortization. So we still got the 760. Now we want to consider the years to maturity at purchase. In other words, the purchase that took place by P to result in this kind of intercompany type of transaction. So S issued the bonds on 2000X1, P purchased them in 2000X2, which is basically 2 years later. This happened January, so 2 years later this happened. So that's 8 or 10 minus 2 is 8 years left. So we're going to say, all right, there's that 760. There's going to be 8 years to maturity. So the premium as of December 31st, 2000X2 is going to be this times this. So it would have been the 6080. And that means that the book value is going to be the original 190 plus the 6080 as of the point in time that P then purchased bonds from the third party. So now we want to consider, okay, what's the proportion, because this is the total bonds, all the bonds, the 190, face amount par value. What's the proportion of bonds that were purchased by P from a third party now? We're going to say, all right, well, they purchased, let's use a ratio, they purchased 76,000 over divided by the full 190. So that's using the face amounts. So 76 divided by the 190 is 40%. So then if we take our 40% of that 196, that will be the book value of the bonds that were purchased by P for 2000X2. So here's 2000X2 bond book value as of that date times the 40% that was purchased by P. That's going to be the 78,432. So that's going to be the, like the book value of the 40% bond purchased that was purchased. Now, how much did they pay for it? Because you would think that'd be how much they paid if they bought it at that. But no, they paid 74,480, which means that they paid less. So in essence, that's what we're calling that constructive gain that we have here, right? That's going to be that constructive gain that we have to deal with. So now that we know that number, let's go back up top, up to these transactions up here, and consider the constructive gain that we have now calculated. We're now looking back into the amount assigned to the non-controlling interest. So like basically the income to the non-controlling interest. We're going to basically add this non-controlling gain, which is going to be the 3952. And then we're going to be taking a look at the 2 years amortization of that gain. So what I'm going to do is I'm going to say this is going to be equal to that amount divided by the years remaining, which we calculated. I'll just pick up down here 8 years remaining. And then we're going to say times 2. So times 2 is going to be the 988. This is going to be a negative number here. I'm going to put this in a negative. Now you might say, where did the 2 come from? Why am I multiplying times 2? That's because the amortization we're having as of 2000X2, that's when P purchased the bonds. And now that was as of December. So we've got 3 and 4, 2 years that we're going to be dealing with regards to the amortization. So let's go ahead and total that up. So I'm going to sum this up equals the sum of these items. And then we'll take the non-controlling interest percentage, which is going to be the 25%. So here's the 25%. And then that's what we're going to be allocating. So that's 270, 964 times the 25%. There's the 67,741. That then is what we expect this number to be after we do our adjusting or elimination entries. That's what we expect this number to be. Now let's consider this number. So what do we expect this number to be? We had the same or similar type of, and that was here. We had the adjustment for the realization of constructive gain on bond retirement. Similar kind of calculation. We're going to be taking, I'm going to say negative. I want this to be a negative of this number. And I'm going to divide it by the number of periods, 8 remaining, and that's going to be the 494. So then we're going to have the realized net income. The realized net income, I'm going to pull this out into the outer column. So I'm going to say this is the sum of these items, which is going to obviously take the 89,000 plus the 15 minus the 494. Then we just need to allocate that to the non-controlling interest, which once again will be, of course, the 25%. So then we're going to take that 103,506 times the 25%. That's going to be that 25,877. The 25,877 that we expect this number to be. Okay, so now that we've done all that basically with tables, let's then next time we're gonna think about the journal entries related to the bonds, and then we'll actually do the consolidation entries, which should be easy to do, and we'll be able to verify them with the tables on the left and be able to reconstruct what should happen with just journal entry formats in a similar process as we've seen in prior presentations.